The average American household carries about $105,000 of debt. Total household debt in the United States passed $18.7 trillion this year. Most of the people carrying it think the problem is them personally. They think they are bad with money, or that they lack discipline, or that everybody else figured out something they missed. That is almost never what happened, and the reason is more interesting than a lack of willpower. What actually happened is that there are a handful of rules about how money moves, and nobody teaches them. The people who know them are quietly using them, while everybody else is being told to skip the coffee. These rules are not secret. They are published and they are boring, and they are the difference between a working life that ends comfortably and one that does not. I'm Tom. This channel is about real personal finance, the kind that works for normal people instead of the kind that sells you something. No motivational fluff, no fantasy returns, no get rich quick, just what the math actually does over time. If that is what you want, hit subscribe. The first rule is that borrowing money does two completely different things depending on what you buy with it. Take $40,000. Borrow it and buy a car. 5 years later, you have finished paying, and the car is worth around $16,000. You spent $40,000 plus interest, and you are holding $16,000. Now, borrow the same $40,000 and put it into something that produces income or grows at a 7% return after inflation. 5 years later, that is worth about $56,000. Identical loan, identical 5 years, and about a $40,000 difference in where you end up. That is not a moral point about cars. Cars are useful, and you may need one. It is a mechanical point about what debt does. Debt against something that shrinks makes you poorer at a rate equal to the interest, plus the shrinking. Debt against something that grows makes you richer if the growth beats the interest. Wealthy households borrow constantly. They borrow against property, against portfolios, against businesses. That is worth sitting with, because it contradicts what most people assume. The rich are not debt-free. Many of them carry more debt than you do in absolute dollars. What they almost never do is borrow to consume something that will be worth less next year. The tool is identical. Which direction it points depends entirely on what sits at the other end of it. And there is a second layer to this that almost nobody explains. When you borrow to buy something that produces income, the interest is often deductible against that income. When you borrow to buy a sofa, it is not. So the same 8% interest rate is genuinely 8% for one person and closer to 6% for another. The only difference is what the money bought. The second rule is that there are two kinds of dollars, and most people only ever handle one of them. There is money you have already paid tax on, and money you have not. Your paycheck arrives after tax. By the time you see it, the government has taken its share. Every dollar you spend from that account is a dollar that already lost 20 to 30 cents. But some money can be moved before that happens. Say you are in the 22% tax bracket and you put $6,000 into a pre-tax retirement account. Your take-home pay only falls by about $4,680. You moved $6,000 and it cost you $4,700. Now run it the other way. To buy something that costs $6,000 with after-tax money, you have to earn about $7,700 before tax. Same $6,000 costs $4,700 going one direction, $7,700 going the other. That gap is $3,000 on a single transaction, and it exists purely because of which door the money went through. This is the rule that explains why two people with identical salaries can end up in completely different places. One of them routed money through the pre-tax door for 30 years. The other one paid tax first and spent what was left. Nobody teaches this because it sounds like accounting. It is closer to a permanent discount code that most workers never enter. It is the single largest discount available to an ordinary worker, and it is sitting in your employer's benefits portal right now. There is a bigger version of that same rule, and it is the one that actually explains why wealth concentrates. Money you earn by working and money you earn by owning things are taxed differently. Wage income runs up to a top federal rate of 37%, and payroll taxes come out on top of that. Profit from selling an investment you held for more than a year tops out at 20%. Same dollar, nearly half the tax rate, depending entirely on whether it came from your labor or from something you owned. That is not hidden, and it is not illegal. It is written into the tax code, and it has been for decades. What it means practically is that a system built this way rewards the transition from earning to owning. The person who converts some of their wage income into ownership every year is moving money from the expensive column to the cheaper one. You do not need a lot to start doing that. You need to know that the two columns exist. The third rule is the one that sounds like a platitude until you see the actual numbers. A dollar has an expiry date. Invest a dollar at 25 at a 7% return after inflation, and by 65 it is worth about $15. Invest a dollar at 35 and it is worth about $7.50. At 45, $3.87. At 55, $1.97. The dollar you invest at 25 is worth more than 7 times the dollar you invest at 55. Not because you were smarter at 25, because it had 30 more years to work. Which means the most valuable thing a young person has is not money, it is time, and it is the only input in this entire subject that cannot be increased. You can earn more, you can cut costs, you can improve your returns, you cannot add years to the front of your life. That is why the advice to start early is not motivational filler. It is the recognition that the cheapest dollars you will ever invest are the ones you have right now. They get more expensive every year you wait. Before that, there is one specific thing that follows from the first three, and it is the closest thing to free money that exists. Many employers add money to your retirement account when you add money. The common arrangement is 50 cents for every dollar you put in, up to about 6% of your salary. On a $60,000 salary, that is $1,800 a year, you did not earn and did not save. Run just that portion for 25 years at a 7% return, and it becomes about $114,000. It is a 50% return on the day of the deposit, guaranteed, before the market does anything at all. There is nothing else in finance that does that. And Vanguard's data shows roughly 1 in 5 eligible workers does not collect all of it. That is not a discipline failure either. Most of them simply never open the form. The fourth rule is that doing nothing is a decision, and it has a price. Money sitting in cash is not neutral. Inflation runs at roughly 3.5% right now. $100,000 left alone in a bank loses about 30% of its purchasing power over 10 years. Over 20 years, it loses half. Over 30, it keeps about a third of what it started with. The number on the statement does not change. What it buys does. This is the rule that catches careful people, and it is worth being clear about who I mean. Somebody who avoids debt, avoids risk, keeps their savings in a bank account, and feels responsible about it. They are not being reckless. They are also losing, slowly, in a way that produces no alarm and no statement showing the damage. Which is a strange feature of this system. Losing money quickly is loud, losing it slowly is silent, and the silent version has taken more from ordinary households than any crash. There is a mirror image of the fourth rule that works against you much faster. The numbers on it are worse than most people realize. The average American credit card balance is about $6,600. The average rate on accounts carrying a balance is just over 22%. That is roughly $1,460 a year in interest on a balance that never goes down. Invest that same $6,600 at 7% and you earn about $460. So, the gap between paying off that card and investing the money is about $1,000 a year, and one side of it is guaranteed while the other is not, which produces a rule with no exceptions in it. Debt costing more than about 7% gets paid before anything gets invested. No investment reliably beats a guaranteed 22%. That is the one piece of financial advice I would give without knowing anything else about somebody's situation. The fifth rule is about where returns actually come from, because most people have never been told. A stock index fund is a single fund that holds a small slice of hundreds of companies at once. Own one and you own a slice of all of their profits. Those companies sell things for more than it costs to make them, and part of that profit is paid out to owners. In a single recent 12-month period, the 500 largest American companies paid out over $660 billion in dividends. They spent more than $1 trillion buying back their own shares. That is over $1.5 trillion of real cash returned to the people who own those companies. If you own an index fund, you are one of those people, not metaphorically, legally. That is the whole engine, not a chart that goes up, businesses selling things and sending part of the proceeds to their owners. Which is why the answer to how do I build wealth is so boring. You buy a piece of the thing that produces money and then you keep owning it for a long time. There is a version of this conversation designed to make you feel better and leave you exactly where you were. You have probably heard that the system is rigged, that it was built by people who benefit from your confusion. Parts of that are true, and I am not going to insult you by pretending otherwise. Financial products are genuinely more complicated than they need to be. Fees are genuinely hidden. The tax code genuinely rewards people who own things over people who earn wages. But there is a difference between a system that favors the informed and a system that is closed to you. Every rule I have just described is public. The pre-tax account is in your benefits portal. The index fund is available at every major broker for almost no fee. The inflation number is published monthly by the government. Nobody is stopping you from using them. What happens is simpler and sadder. Nobody told you they existed, and the people who did know assumed you did too. That is not a conspiracy. It is a gap in what schools teach, and the practical difference matters enormously. 30 states now require a standalone personal finance course to graduate high school, up from 17 in 2022. That is a real improvement, and it arrives about 40 years too late for most people watching this. If you are over 40, you never had that class. If the system is rigged and closed, the correct response is anger and nothing else. If it is public and unexplained, the correct response is to learn the 4 or 5 things that matter and then act on them. I would rather give you the second version because it is both more accurate and more useful. There is a 6th rule I almost left out. It quietly takes the most from people who are otherwise doing everything right. What you pay to hold your investments matters far more than it looks. Take $200,000 invested for 30 years at 7%. Left alone, it becomes about $1.5 million. Now, charge 1% a year, which is a standard advisor fee, or an expensive fund with the cost buried inside it. The same $200,000 becomes about $1,149,000. $374,000 gone to a single percentage point. The reason it does that much damage is that the fee comes out every year before the growth is calculated. It removes the dollar and everything that dollar would have earned for the rest of your life. A 1% fee is not a 1% cost. It is a permanent reduction in your rate of return, and the rate is what the whole machine runs on. Now the honest limits, because everything above has them. The first is that these rules do not overcome a large enough income problem. Somebody spending everything they earn on rent, food, and transport is not failing to optimize. They are running a household on a budget that does not have room in it, and no amount of tax knowledge changes that arithmetic. For that person, the lever is income, and it is the only lever that moves anything. I am not going to pretend a pre-tax account fixes it. The second is that starting position matters, and it is unevenly distributed. Somebody who inherits a paid-off house starts a lap ahead. Somebody supporting a parent starts a lap behind. That is real, and knowing the rules does not erase it. What knowing the rules does is stop you from losing ground you did not have to lose. That is a smaller claim than most financial content makes, and it is the honest one. The third is that I have described a system that has held for a long time in one country. American stocks have returned about 7% after inflation over the last century, and that record is real. It is not a guarantee. So here is what I would actually do with all of this. Find out today whether your employer offers a retirement account with a match and what the match is. If you cannot find it in the benefits portal, one call to Human Resources settles it in 5 minutes. That is the pre-tax door and free money on top of it, and roughly 1 in 5 eligible workers does not collect it. Then look at what you owe and sort it by interest rate, highest first. Most people have never seen their debts in that order. Anything above about 6 or 7% gets paid before you invest another dollar. A guaranteed 22% saved beats an uncertain 7% earned. Move whatever cash you will not need in the next 5 years out of a savings account and into something that grows. The silent loss is the one nobody notices until it has taken half. And then leave it alone because the 5th rule only works over decades, and every instinct you have will tell you to interfere with it. None of that requires you to be clever, and none of it takes more than an afternoon. It requires you to know 4 or 5 things that nobody bothered to explain, which is the actual answer to the question in the title, and it is duller than the conspiracy version. Money itself is not complicated. The complexity is a side effect of the people selling it to you. Underneath it is a small set of rules anybody can learn in an afternoon. You have now got most of them. 6 rules. Debt does opposite things depending on what it buys. There are 2 kinds of dollars, and one is much cheaper. A dollar invested young is worth several invested later. Cash loses quietly. Returns come from businesses paying their owners, and fees come off the top of all of it. That is the syllabus nobody handed you at 18, and it fits on an index card. Most of what gets sold as financial education is elaboration on those 6 points or distraction from them. If this was worth your time, hit subscribe. I will see you in the next one.